All right. Morning, Jason.
Good morning. Good morning, everyone that's coming in.
Yes, good morning, everyone. Welcome to AllGen's quarterly market update and review. Today is April 16th, 2026, and one quarter of this year in the books. And man, seems like it's been more in the quarter because so much going on. So that's why we're here to talk about our perspectives on what's going on, especially as it relates to the investment markets and financial planning. So welcome again. We're gonna, as you know, if you've been here before, we like to get some engagement going on. And for the engagement, it will happen a couple different ways. We invite you as we're speaking to please feel free to type in any questions you may have in the Q&A button. The raise hand is wiped out, but you can um, type in questions in the Q&A. Preferably, we'll look see the chat. We'll prefer the Q&A so we can have it all in one place. This webinar will be recorded. So right now it's in listen-only format for all the attendees, and you'll get a copy of this usually within the next 24 hours. But again, we will look at all of the questions and try to answer all the questions. We usually wait till the end of the webinar to answer the questions after the presentations are done. But feel free to, as the presentation goes, if something comes to mind, hey, I want them to address this, and we'll go from there. We also try to get you engaged with a couple of questions, survey questions. So as people come in, we invite you to have your phone or computer ready so you can answer the following questions. And we'll start light because this is going to be a serious presentation. But as spring gets underway, we just passed tax day. We're middle of April. Summer plans are starting to pop up. What are you most looking forward to in the next coming months? Traveling or weekend getaways, outdoor activities such as going to the beach, parks, or sporting activities, home projects or spring cleaning. That would not be me. And spending time with family and friends. So, what are you looking forward to in the next few months as school wraps up and warmer weather arrives? So I'll give you a few seconds to answer the question. All right. That being said, let's see where our audience's mind is. So we've got, pretty even split, but a lot of people traveling and weekend getaways or outdoor activities, or it could be a combination of both, right? So very good. Yeah, most people are in my camp are not really into the home project and spring cleaning stuff. And then some people spending time with family and friends. Very good. So next question is a little bit more serious in terms of your perspective. A lot going on in the world. So with given the ongoing global conflicts, what do you think could have the biggest impact on the markets this year? I know first quarter we started off with Venezuela conflict. Now we're, more in a different side of the world. So what do you think could impact the investing markets this year? Energy prices and inflation pressures? Market volatility and investor sentiment, global trade and supply chain disruptions, or government policy and interest rate responses? This is, I know, deep thinking questions for a webinar that you are supposed to be hearing our thoughts, and you will. But just want to get your thoughts there for a second. So I'll give you, since it's a compounded answers for each choice, a couple extra seconds for you to think through what you think could have the biggest impacts on the markets this year. All right. So as the answers come in, let's see what where people are thinking, and it's okay if you don't have an opinion, or honestly, I don't know, and that's okay. That's why we're here. So survey says it's not coming up. There you go. Okay, most people, energy prices and inflation pressures, with a second one, global trade and supply chain disruptions are the biggest concerns or thoughts as far as people thinking could affect the markets this year. So speaking of markets this year, let's jump right in. Again, please feel free to ask any questions in the Q&A section. And then we'll just turn it over to Jason right now. And Jason, tell us what is going on in the world.
All right. Hello, everyone. Excited to get into this market update. Lots of things been going on over the last quarter. So jumping right in here, just a quick review. Where are we at year to date on some of the major indices? So as you can see, just looking at it from now until let's see, we went through 414 on this one. Gold up 12.3. We got small caps up 10.3, and we have international up 9, and the S&P or U.S. large cap stocks up 2, bonds up almost 1%. So you look at those numbers, you look you would think that's pretty good. But a lot has happened in between all of that. So you obviously had gold start the year very strong. You can see the big jump there. However, war started at the end of February, and you can see on this dashed line here what happened to markets. Gold took a massive hit, large percentage drop right there. You have international and small caps that also dropped as well. And then you had US stocks that actually went at an intraday low as 9%. And then you had most recently the peace started. You had the blockade, and then before that you had a ceasefire that started, and that was right around this area, and you've had markets rebound. Now, a couple of things to pay attention to here. I know this is starting to become a very busy slide now, and I'll dig deeper into this as we go. But if you look kind of pre-war levels, and then you kind of just drag a line sideways, you can see international markets and small caps about right where they started pre-war. Same thing with the S&P. Actually, the S&P is slightly higher than pre-war. So after that big drop, markets are actually back to where they started, and some even above where they started. So obviously, as the war occurred, what was one of the main things that caused all the disruptions was that the price of oil significantly jumped. So you can see this is the price of oil here. And as you look here, going through 2026, it's starting to decline late 2025, started kicking up in 2026. Then you had the war start, and you went from about $65 a barrel right here to as high as $120 a barrel. Now, after the ceasefire stopped, you can see it's gone from nearly $115 a barrel down to 91. So that has dropped pretty significantly. However, still way above where we were over the last year. And so that's caused all types of problems in the global economy. And so as we kind of look forward to what is obviously causing that disruption in oil, not just the war, but specifically the Strait of Hormuz. And with the Strait of Hormuz, 20% of the world's oil and natural gas goes through that. So what I've done here is just created a chart of daily vessel transits. It's funny as you get into, as a portfolio manager, you have to become an expert in multiple different areas. So during COVID, I had to be an epidemiologist. Now I have to become an expert on maritime travel. But so as you can see here, pre-Iran war, you had daily vessels of about 120, close to 120 a day. You can see even if we went back a little bit further, it's up closer to like 135, 140 pre-war. And then with the blue line being just the tankers, oil tankers, you can see how that dropped significantly. So after the truce started, you did start picking up a little bit. Then you had the blockade that started, still higher than where we were right after the war started, but as you can see, clearly much lower than pre-war levels. But you have to think about this as not just how many oil tankers are going through on a daily basis, while we do track that. What the market does is the market looks forward. It's what's called a forward-looking mechanism. So the market is taking into consideration all the things that it thinks is going to happen in the future. And so you have a lot of smart people out there, a lot of large money managers that are basically making bets on what they believe to come, and they have a lot of sources that you're not seeing in the news. So what they are anticipating, and the reason why the market rebounded, is that we are on a track, at least now, to potentially start to increase the amount of oil flowing through this strait. And also, there's been other things that have happened, redirected pipelines, other things, other measures that have been taken place to try to make up some of that supply. So the market's looking out forward to say, okay, 3 months from now, 6 months from now, where is oil at? And even though the ceasefire is still fragile, the market at least is anticipating that things are going to start to improve from here. But no one knows. So now what I want to focus on in these next few slides is sentiment. I'm going to look at a couple different types of sentiment. I'm going to start focusing here on investor sentiment. Just a quick, for those who are not familiar with what sentiment is, it's basically investor sentiment is how investors feel about the market. And so you go when times are good, people are very optimistic. When times are bad, people become a lot more pessimistic. Now, what's interesting is the amount of change that we've had just since we did our last webinar. In the last webinar, I pointed out that we reached an extreme level of optimism. And just to explain the chart here, you have the S&P 500 up top, and then you have Ned Davis's research, and it's a research partner of ours that does what's called this daily trading sentiment composite. It's basically a composite of multiple sentiment indicators, and it does a good job of tracking investor sentiment. Now, the way you read it is when you go above this top dashed blue line, you've reached extreme optimism. And when you go below this bottom dashed blue line, you've reached extreme pessimism. And so, as I warned everyone at the beginning of the year, that the fact that we had some extreme optimism, that's usually a negative for markets. However, fast forward, go through the war, and now, as of a couple of weeks ago, when it seemed like it was really bad, we reached an extreme level of pessimism. Now, I point this out, one, to give you kind of where conditions are right now, but the more important way to look at this is, okay, what do markets do? Not how do I feel, but what do markets do when the sentiment of the market feels a certain way? So I've put 4 dashed lines here of other times where the market has reached extreme pessimism. And you can see afterwards, the market has had good rallies after extreme pessimism. And we've even started that more recently here in the short term. So when you reach extreme pessimism, and we're not in that now, we just came out of that, but when we were, or when you are historically, so that below this dashed blue line right here, markets have an annualized return of 25.7%. Where we are right now, we've come out of that. We're in the neutral area, and markets have an average return of about 9.46 in this time period. Now, the reason why I point this out as well, and I want you guys to, I'm going to reinforce this over the next couple slides, but I really want, part of our job as investment advisors and as advisors of our clients on this call is that we want to teach our investors and the community that follows us how to be good investors. And I put a little quote here at the bottom from Warren Buffett. It says, "Be fearful when others are greedy." Or I could state this in another way: be fearful when you have extreme optimism. Be greedy when others are fearful. So when markets go down and people get scared, that's when you need to get excited. You have to do the exact opposite of psychologically how we're wired. We're wired in a flight or flight standpoint. And so when things get bad, we want to either run or fight. But in the market, you almost have to do the opposite of what your emotions feel like. And so when things get bad, we have clients call us sometimes. They want to go cash. And we had a couple of those calls and people that asking us to walk them off the ledge over the last few weeks. And we welcome those calls, by the way. If you're ever feeling that, please give us a call. But I say that because some of our investors that have been with us a while have now started to switch that. And when things get bad or perceived bad, or when the sentiment is bad, they start to get excited and actually want to invest more money. So this chart, and as we go into this next chart over here, can point it out from a different level. Now, this is a little bit busy too, but hang with me here. So now we're focusing on consumer sentiment. We were just looking at investor sentiment. Now this is consumer sentiment. Consumer sentiment is more, instead of how people feel about the markets, how do they feel about their own personal finances and their own personal financial future. You think that when people felt really bad about their own personal finances, that would be bad for markets. But that's not the case. In fact, it's the exact opposite. And so, as you can see here, when sentiment is high, consumer sentiment, when people are feeling good about their finances, which it covers 10 peaks here, the average returns are up 5%. Now, the troughs, the low points here, when people felt extremely bad, consumers felt extremely bad about their finances, which, by the way, we're in that state right now. You have an average annual return of 24%, which are pretty good returns. So again, from both from an investor sentiment standpoint and from a consumer sentiment standpoint, you can see that when people think times are bad and when people feel bad, that's usually a good time to invest. One last chart here on the consumer sentiment to give you a different point of view. This is going all the way back to the 1970s, but this is tracking the University of Michigan Consumer Confidence Index. So this is also looking at consumer sentiment, but similar the way the chart works here. You got the S&P 500 up top, and you have the red dash line, which would say they're extremely optimistic about their finances, and then down here they're extremely pessimistic. And you can see over the last couple of years or so, they've been extremely pessimistic. Now, what's interesting about that is down here we're showing the market returns when you reach these extreme levels of pessimism from a consumer. And so all the red dots are extreme pessimistic feelings from the consumer. And you can see we have a lot of red dots here over the last couple of years. Now, over the short term, it doesn't really tell you a lot, even though markets are majority of the time up. And by the way, to explain this, win rate means how many times after this occurrence happened is the market positive? And then what are the median returns and for each one of these time frames? So if you focus a little bit more on the long term and say, okay, when consumers are extremely pessimistic, like they are right now, 1 year later, markets are positive 93% of the time with a median return of 18%. 2 years later, it's up 92% of the time with the average market returns cumulatively of almost 30%. 3 years from now, 100% of the time markets are up, and on average a cumulative amount of almost 52%. So I say all this to say we never know the future, right? We don't know where markets are going to go, but we use a weight of evidence approach. And if we're using a weight of evidence approach, the weight of sentiment right now would say, okay, markets should do well from here. That's just one piece of evidence. That's not everything. We'll look at other areas, but from a sentiment standpoint, it looks more positive for stocks. And from an investment education standpoint, I'm begging you guys not to follow the herd. Don't fall into the trap of kind of your emotions going along with news headlines and it causing you to want to get out when very good opportunities in the market present themselves. Everyone has heard the saying, buy low and sell high. However, human beings, as you can see by these charts, naturally do the opposite. People want to buy when everything feels good. Well, that's when the market's close to the top typically. People want to sell when everything feels bad. And that's when markets are typically near the bottom. So hopefully you guys get the point. Let's move on. All right, so looking at valuations, from a valuation standpoint, another thing I pointed out at the beginning of the year is valuations are very lofty. This is looking at U.S. valuations, so the valuations of the S&P 500, and one of the top 3 times over the last 30 years. However, after the recent pullback and with earnings continuing to grow, we're now no longer above this dash line, which is above 1 standard deviation. We're close to it, but valuations have still improved. Now, that being said, the 30-year average is down here, and so we still have lofty valuations on the U.S. side of things. We're using the weight of evidence side. Valuation would say, hey, you got to be a little bit cautious on U.S. stocks because they're expensive right now. Okay. However, that being said, margins are very strong. So if we look at the chart here on the right, this is looking at margins of company. Basically, when margins are high, that means companies are making a good percentage or they're making good profits. And you can see we just went into a new high. So margins are very high. That's usually good for the market. You can see here during a recession, margins drop. And at the same time, growth going forward, so earnings growth is predicted to be for this year 17% earnings growth. Last year was at 13%, and the year before was at 10%. So that would actually be an improvement. And then you see 27 and the estimate for 28. Now these estimates can change over time. They're just estimates, but still, they're still predicting some growth, pretty strong growth for 2027 and modest growth for 2028. So again, wave evidence approach. This is actually a little bit more on the positive side. That earnings growth looks pretty good in the U.S. and for the next year or two. That could change, but that's where we're at right now. So from a dollar standpoint, this is it's very important to track the dollar. And what's interesting is there's been you almost I can't tell you how many times since 2008 I've had clients send me, or I've also seen the same headlines or emails myself that the market's crashing, emerging markets are creating their own currency, the dollar's going to go to zero, it's not the dollar's going away. Well, since that time, and I've been receiving all of those emails and been seeing the headlines myself from 2008 up until most recently, the dollar has been uptrending. So the dollar has actually been long-term in an uptrend for almost 20 years, about 18 years. Now, this trend line here is what we're watching. And so as you can see here, over the last, really since 2022, you've had a shorter term downtrend. Now, the secular longer term trend is still intact, but you've had a shorter term downtrend right here. And you can see it's testing this support line. It's not quite officially broken it. It's kind of hovering right there on that trend line, but that is something that we're watching very closely. It is currently below that trend line, but it hasn't clearly broken down below that. But that is something we're watching. Now, I'm going to go back and forth on this slide, or keep referencing this slide, because you look from 2002 here to 2008, and you can see how much the dollar got weaker during that time. Remember that. I'm gonna reference that here in a little bit. Now, if we just focused in on a very short-term measure, this section right here, that's this slide. So really over the last year, the dollar has been kind of range bound. It's in a sideways trend. And what's interesting is, kind of back to the sentiment point of view, people were freaking out when the dollar dropped right here, literally. And we had a lot of different calls on this, and that the dollar was crashing. Now, what's interesting is the dollar went from almost quote unquote crashing to rallying back to 1-year highs. Things can change really quickly. Now, I'm not saying the dollar is going to continue to get strong, and I don't know if it's going to go into a downtrend where it hasn't kind of given that signal yet. It's range bound right now. But what we are watching that would give us comfort, or at least a little bit more evidence that the dollar is going to continue to either break the uptrend and start to downtrend, or go back into an uptrend. So if you can break above this high, this would cause you to think that the market's going to, or the dollar's going to go get stronger. And as we come down below this trend line, this would cause me to think the dollar is going to go into a new downtrend. So so what I'm doing here now is we're taking the dollar, what we learned about the dollar and what we saw there in the dollar, that we're still in an uptrend from a long-term point of view. However, the last couple of years, it has been in a downtrend, and it is potentially changing into a new downtrend. Now, if we just looked year to date, what has the dollar, both the dollar and gold, what have they done, and what is the relationship between the two? So the purple line is the dollar, the gold line is gold. And so as you can see, in general, when the purple line or the dollar goes down, gold tends to go up. Okay, and then here we go. We can see now the dollar going up right here, and then gold from that point to that point going down. And then more recently, the dollar starting to get weaker again, and then gold going back up. So it's an inversely related or negatively correlated asset historically over time. So one of the reasons why gold had a pretty large pullback recently was because this purple line from here to here, when the war started, the dollar got quite a bit stronger, which causes gold usually to get weaker. So that's one of the reasons we continuously follow the dollar, because it can have an effect on gold prices. It also has effect on other things, which I'll explain here in a little bit. Even though even though gold has dropped over the short term, and it is still up pretty solid on the year. And you can see this is looking at it from a very long-term point of view. I've referenced this chart over the last few webinars just to reinforce that there are certain what's called secular trends. Secular, when you are talking about trends, that terminology, secular, means long-term, usually 10, 15, 20-year time frames. And so you can see gold, this is a chart of gold, was in a secular uptrend, and it went up 1,830% over 11-year period in the 70s. and then it was in a secular downtrend from 1980 to 2000, entered a new secular uptrend in 2000. In 2000, and it was up 638%. And then most recently, it's in a secular uptrend again, and gold has been up 356% over the last 10 years. Now, some people think gold has gone up a lot, which absolutely it has, but they may think that maybe it's run its course and it's not going to go up any higher, and that is potentially the case. However, if we look at the last two secular trends from a percentage standpoint, it's gone up much higher the last couple times. So we'll see if it repeats that. From a time frame standpoint, it depends on when you start this new secular trend. If I started it right here, which one as it broke this trend, that would be only about 5 years or so. But if we start here closer to the bottom, it's been in a 10-year trend. All that to say is I think there is still definitely the chance that gold can continue to go up if it repeats what it did over the last two secular bull trends. Okay, now we're comparing gold to the S&P 500. And we use this type of ratio analysis quite a bit because when you're managing a portfolio, if you, let's just say, for example, you want to add money to gold. Well, if you're adding money to gold, you have to pull money from somewhere else. And so where are you going to pull it from? And so we use this ratio analysis to say, okay, if one asset class is going up, where are we going to pull the money from to add to that asset class? But it's also kind of just to let us know one of the pieces of evidence to say we believe that that a trend is outperforming one way or another, and one asset class could continue to outperform. So again, this is looking at gold versus the S&P when this line is going up. Gold is going up at a faster rate than the S&P 500, meaning it is outperforming the S&P 500, which you can see in the 1970s that happened. And then from a 20-year period, the S&P outperformed from 1980 to 2000, and then again from 2000 to 2012 or so, gold outperformed. And then as you can see more recently, we've started to go back into this kind of secular outperformance, not just uptrend of gold, but an outperformance of gold compared to the S&P 500. And as of this is the first webinar I've showed this where it actually has broken above this resistance, these two last highs, which act as resistance. So we are now above that. Now, so trend analysis is one way that we look at things as one piece of evidence. At the same time, we also want to look at other fundamental factors. And this chart right here, also by Ned Davis, is a good chart to be able to show gold as a share of official reserve assets of central banks around the world. And so, as you can see here, a couple different lines. The blue line is the world, so that's all of them together. Yellow dashed line here is advanced economies. Gray dashed line is emerging markets and developed economies. And you can see pretty much since 2022, all of them have been increasing their share of gold compared to the reserves. Now, part of that is just because the price of gold has gone up, so that's made a bigger percentage of their overall reserve assets. But that's not the only reason. They've also been we track how much central banks around the world are buying, and that is still continuing to happen. They're still buying a lot of gold as their reserve currency, even throughout the war. And so we checked it even in March as well. All right. So switching gears now, not just gold, but now we're looking at this kind of whole sector of commodities. So commodities would be metals, obviously precious metals, basic material kind of metals, and then agricultural products, coffee, different corn, soybeans, all that type of stuff. So this CRB index is the indice that tracks commodities as a whole. It's the basket of all of those commodities together. And then if we compare the CRB, which has recently been in an uptrend, but if we just compare it from a ratio analysis to the S&P 500, you can see from 2012 all the way to 2020 or so, the S&P just significantly outperformed commodities. However, after COVID and after a lot of quantitative easing, lowering of interest rates, printing money, sending money, you had an inflationary time period in kind of 2022 and even after 2021. And you can see here when this line is going up, commodities are outperforming the S&P 500. And then the S&P 500 kind of started doing a little bit better up until this year. And so if you look this year, a lot of this has to do with oil, but it's not just oil. If you look at a lot of the other commodities, a lot of other commodities have gotten much stronger as well. And so as you can see this trend break right here, commodities are now starting to outperform the S&P 500 again. So something we're watching, because there are time periods throughout history where the S&P 500 does outperform, the commodities outperform the S&P 500. So looking at the same ratio, this is commodities versus the S&P 500, but specifically looking from 2000 through 2008. And so you can see as this line is going up, that means commodities are outperforming the S&P 500. And so that was a long time period, that almost a 10-year time period where commodities outperform the S&P 500. One other time frame is this is looking at the 1970s, so 1970 through 1980, also an outperformance of commodities over the S&P 500. And just backing up 1 second to go back here, if you remember the weakness in the dollar, there was a weakness in the dollar kind of from 2000 to 2008. When the dollar gets weaker, sometimes that also helps commodities out too. And that was kind of in this time period right here where the dollar was getting weaker and commodities were outperforming. So the last thing I'll say about kind of one of the important things of watching the dollar is focusing on international stocks. International stocks tend to outperform when in a weakening dollar environment. So this is looking at the S&P 500 versus developed markets. So similar concept. If the line is going down, that means developed markets, international markets, not including emerging markets, are outperforming. And see, from 2002 to 2008, international markets significantly outperformed the S&P 500. That also coincided with the dollar downtrending, that 2002 through 2008 time period. And then fast forward and look through 2010 all the way up until 2025, you had a significant outperformance of U.S. stocks to international stocks. And what we've noticed over time is that portfolios, especially new clients that are transferring over from other advisors, or they're doing it themselves, because the S&P 500 has outperformed, and U.S. stocks in general have outperformed international stocks, people have tended to overweight U.S. stocks and not hold some. We've seen some portfolios with no international, or just a very small amount of international, and that is natural because people tend to follow what's doing well and increase and continuously put more money into what's doing well. However, there has been a trend change here recently. As you can see, this upward trend line has started to break, and international markets have started to outperform the S&P 500. And really that started happening kind of beginning of 2025. And you see from over the last 2 years, we have been in a new trend where international stocks are outperforming U.S. stocks. That's also been the case so far this year. So that's something that we've been pointing out. We've been adding to international stocks really since the start of 2025. And even on this recent drop in the market, we added a little bit more to emerging market stocks, which takes us to our next index. So this is looking at the S&P 500 versus emerging markets. And so, sometimes people think that the S&P 500 is the main game in town, and you're just going to own the S&P 500 and you'll be fine. And you actually have been really fine since 2010, all the way from this time period right here, 2010 period all the way to 2025. That would have been the right strategy. Just holding U.S. stocks in the S&P 500 would have significantly outperformed a diversified portfolio or emerging markets, as this chart is showing. So this chart is saying, as the line is going up, S&P is outperforming emerging markets, but as the line is going down, emerging markets are outperforming U.S. markets. And there is a significant outperformance from really kind of 1999 all the way to 2010 of emerging markets over the S&P 500. And I don't have the exact percentages off of memory, but it was something like The emerging markets did close to 200 to 300% versus the S&P pretty much being flat during at least from the 2000 to 2010 timeframe. So it was a significant outperformance. But notice here when the bulk of that trend happened, when the dollar was downtrending. So that's why we're tracking the dollar so closely. If the dollar continues to, or does actually break that long-term trend line and does go down lower, historically, international stocks and emerging stocks in particular have outperformed. All right, so that was a lot of trend analysis. And that's only one way we look at stocks. The other thing is valuations. And so, again, as a weight of evidence approach, we would also look at valuations. And you see here, what this shows is that the purple line being where current valuations are, and that's really the one we're going to focus on, and the gray area being the 20-year, the dark gray area being the 20-year range of valuations. And then this light line here is the average of those last 20 years. So basically, to explain it, if the purple line, where valuations are now, are above this average, it means that stocks in that region are trading at higher valuations or more expensive than they have been over the last 20 years. And that's definitely the case for US stocks. You can see it's higher than its average. However, look at Japan. It is slightly higher than its average, but it's much closer to its average. And then you look at the Eurozone, pretty close to its average as well. Emerging markets are actually at their average. And then China, also being an emerging market, is at its average. So not just are conditions setting up for international stocks to potentially outperform because of a weakening dollar, but if you're looking to if you're a value money manager and you're looking to move money into where more value is, then you're seeing more value in emerging markets and even some international markets compared to the US. Meaning, if we're looking at kind of forward PE ratios here, there is a discount to buy emerging market stocks and international stocks in general compared to where the US is. Now, in general, there usually is a discount because US stocks tend to have more capitalistic policies, or US as a whole has more capitalistic policies. They tend to be focused more on profits, and they tend to grow at a faster rate. So there typically is a discount. However, the discount now is significantly more than kind of the average discount. So from a valuation perspective, that does make international stocks and emerging stocks in particular a little bit more attractive. And so fast forwarding to, or switching gears here and looking at rate expectations, part of the problem with the war starting and oil prices going up is that it caused inflation to go higher, which I'll dive a little bit deeper into inflation going higher in a second. But what that does from the standpoint of the federal funds rate and the Federal Reserve is if you look here, the FOMC, this is where the green line is where the federal funds rate has been historically. And right now we're at about 3.75 on the high end. 3.5 to 3.75. And then you look at where the FOMC predicts to be by the end of the year, a quarter of a point lower. Well, market expectations actually don't see us having any rate cuts this year. When we started the year, market expectations were over here expecting two rate cuts, somewhere in this range right here. They were expecting 2 rate cuts. After the kind of war started and inflation started picking up, now we're not expecting any, the market's not expecting any rate cuts. That could change. Maybe the war, the ceasefire sticks. We have peace in the Middle East, and then commodity prices come down. There's a possibility that where we still do have an interest rate cut. I'm not saying that's going to happen, but that is one of the possibilities. Or if not, we would probably not have potentially any interest rates increases. And as of right now, that's kind of where, with conditions where they are right now, that's what it's looking like. It's looking like there's not going to be any rate cuts this year. So something we'll continue to monitor for sure. There's a lot of things that could potentially change that, but that's where we're at right now. All right, so based off of interest rates, because interest rates have a lot to do with where bonds go. That's not the only factor, but it is one of the factors. And so if we're looking at the bond market and what has done well this year, what has actually done the best is emerging market bonds in local currency, meaning not dollar denominated currency, but they're in the local currency of the country. So let's just take for Brazil, for example, if you had a Brazilian bond, it would be in the Brazilian real. Or if you have the Mexican bond, it'd be in the Mexican peso. So holding bonds in those currencies have actually done well this year, and they're up about 2%, a little bit more than a quarter of the way through the year. So that's pretty good if we're just looking at that short time period for a bond return. That's actually very good. If you were to annualize that, which I would never annualize a short-term time frame, but just to give you perspective, that would be averaging a return for the year of over 8%. So on the other side of things, short-term treasuries have only done about 0.5%. More longer-term treasuries up about 1.25% for the year. MBS has done well. TIPS, which is inflation protected securities, have done well as inflation has come up. And actually, high yield corporate bonds have done pretty well. I mean, muni bonds pretty solid here. And so one thing I want to point out in this chart is just kind of what's been doing well. How does this factor into interest rates? How does it factor into the dollar weakening? So part of, as we manage our clients' portfolios, obviously you have, if you think the dollar is going to go down and you have political uncertainty, maybe you add gold to the portfolio. If you think from a stock perspective that the dollar is going to go down, you would potentially add international stocks and emerging market stocks. Now, from a bond perspective, if the dollar is going to get weaker, emerging market bonds in local currency makes sense. And that is something that we do hold in our portfolios. And when the market dropped recently, as the dollar got stronger, it gave us an opportunity to add a little bit to those areas. Now, that is a very historically one of the most volatile bond components. So we don't hold a lot in that area, but it does make sense as kind of a hedge to a falling dollar and as a good way to kind of diversify over time. The bulk of our bond portfolio would be more in MBS, treasuries, if it's a taxable account, muni bonds, corporate bonds. And this kind of has all of the bonds, U.S. bond categories, and there's the corporate bonds. So that's where the bulk of our portfolio would be the safer kind of money within bonds. But to try to get a little bit of extra return, that's why we've added the emerging market local bonds and to protect against a falling dollar. Now, to the inflation chart. So I think it was just this week, or was it, I couldn't remember, his last week or this week, but the most recent numbers came out for the CPI, and these were the March numbers. So this did include the after the war started, and you can see the headline number jumped from where it was in February pre-war of 2.4, jumping all the way up to 3.3. The headline number includes energy, food, the more sensitive, more volatile components of the CPI. So if we're breaking that down, looking at this most recent reading right here, and seeing which color here, all these colors are the different components of the consumer price index, and energy being this green component. So you can see what has added significantly over the last month. So you don't see any green in this prior month because energy didn't add really or subtract to the CPI in February. However, it significantly added in March. Now, if we remove energy and food, which would be kind of your more volatile components of the CPI index, you can see the core portion only went up 0.1%. Meaning if you were to take out this energy right here, we're right here pretty close to where we were over the last couple of months, and still not quite to the 2% target. We haven't been able to make it there since after COVID. That's the Fed target. But we're still not too bad at 2.6%. So that will be something to watch over time, because as oil stays up, that can then flow through to other areas. Transportation costs start to increase, which then starts to increase a lot of other components, especially food, but a lot of other components as well of the CPI. And so that's something that we were going to watch to see if this is just a short-term thing with oil being up, and once it comes down, it's not as big of a deal for the inflation standpoint, or if it stays up for an extended period of time, that can start to feed through into other areas. All right, so to sum it all up here, gold's still been strong. Even after the market dropped, it has still been strong. even like I said, after that pullback. But one thing we're seeing here is now commodities are starting to outperform U.S. stocks. International emerging market stocks have outperformed since the beginning of 2025, and potentially secular trends are starting to change there, which could indicate, it's possible that it could indicate a longer term trend where international emerging stocks market stocks start to outperform the U.S. over a secular time period, a 10 or 15-year time period. No one knows the future, but the charts are kind of indicating that it's looking like that's developing. It could happen. Geopolitical uncertainty obviously is still very elevated with the war, and so I would still expect high levels of volatility. But volatility isn't always a bad thing. It gives you opportunities to get in a lower price. So, kind of bottom line from what I wanted to help our investors know is that most successful investors stay focused on the long term and not on the headlines of the day. That's a key thing to focus on. And you can't allow yourself to kind of fall into that herd following mentality. And just because everyone's scared, you get scared. Just because the news is scared, you get scared. From the standpoint of investing, that usually doesn't work well. And then obviously we build our portfolios with a very disciplined strategy, focusing on managing risk really well. We're very thoughtfully selected holdings in less correlated and sometimes negatively correlated assets so that everything isn't going up and down at the same time, and we can protect portfolios through multiple different types of markets. All right, so before we jump into the AllGen updates with Paul, I did want to give you some breaking news here. We do have some new portfolio strategies at AllGen, and I'm not going to go into them now, but I'm just giving you the heads up that we are going to have a webinar coming up on a new strategy we have called the AllGen Crypto Alt Shield strategy, which is a portfolio that can own things other than just kind of stocks and bonds. It can own potentially cryptocurrencies, different commodities, and what it does is it shifts between those to try to be in the assets that are of that pool of assets that are uptrending. So I'm not going to get into it now. We are going to have a webinar on that. So stay tuned. But we've also introduced direct indexing as a strategy, which works really well for those who are in high tax brackets or have a big capital gain coming from the sale of a business or a sale of a stock that they had low cost basis, sale of a property. It could really help you save a lot on your taxes, and it's done in the AllGen way where we're trying to manage risk really well. And so just wanted to give you the heads up and to stay tuned. And if you have any questions before any of those webinars start, feel free to reach out to your advisor, and they can explain to you a little bit more about those strategies. All right, Paul, take it away.
Very good. Thank you, sir. And wow, that's a lot of information. Thank you for all that. Yes, we want to get to the engagement part where I know there's a few questions that have been thrown at us. Before we go there, let me remind you, you can please type any questions that you have in the Q&A section. We'll get to those momentarily. And also, Jason, since you were talking about the new portfolio strategies, AllGen Crypto and direct indexing, I want to remind people of an old strategy, which is tax loss harvesting. Because I've been a benefactor of that recently, and as of a lot of people who, the volatility, as you mentioned, is not a great thing from a sentiment standpoint, but does provide opportunities to really help on the tax situation, which, I've heard the old saying, it's not how much you make, it's how much you keep, and tax loss harvesting can be a huge, complement to a portfolio where you can make a good amount, but you can also save on taxes. So that's, I know, something that you and your team are constantly looking to implement and manifest, especially during these markets.
Absolutely. We did it on this recent drop and saved our clients quite a bit in taxes.
Very good. Very good. So again, please feel free to add any questions you have. And while you do that, I'm going to remind you of some resources. If this is good information for you, and this is very market-based, we have more of this on our blog. And our website, which is the blog session. We have YouTube videos, so feel free to go there, subscribe to our channel, and you can see anything that's been updated. At the same time, we also have financial planning updates because, as you know, we do planning as well as investment management. So we encourage you to visit our website, become a follower on our YouTube. We have an Instagram channel as well. So we're trying to get information out to you as much as possible. And I'm going to talk to that in a second here because one of the things that we've been doing is really trying to ramp up our marketing efforts. Okay. So as we do that, from a financial planning update, go ahead, Jason. You can go to the next slide. We have a couple of weeks left. If this is applicable to you, Florida prepaid enrollment ends in a couple of weeks. So if you are familiar with the Florida prepaid program, you can prepay a child or grandchild's tuition at today's rates for their college costs whenever they go. Um, so it could be a great way to do that. My kids were a benefactor of this program. Um, Honestly, I was not a big advocate of the program many, many years ago, but they've really retooled and revamped it, and it's actually can be a very strong program. At the same time, tax day was yesterday. It passed for a lot of Americans, but there's a lot of us who filed extensions to the deadline. Okay, so if you're in that camp, especially as a small business owner, there's not much we can do for last year in terms of getting deductions at this point, but there's still the old SEP contribution deadline, which if you file an extension, it goes with that extension. So if you're a small business owner or sole proprietor, you have till September 15th, technically, to still establish a SEP or make a contribution to a SEP and still take a deduction for last year. So something we encourage you to talk to your tax or to us advisor to see if that makes sense in your particular circumstance. Okay, financial planning update. As you know, we always encourage you to update your plan. We're doing a lot on estate planning recently. We want to make sure our clients have a good will and trust established. So we want to make sure we check that box off and really help you towards your path to financial freedom. So if we haven't checked, we'll be reaching out to you if we haven't touched base in a while. But if there's something major that's changed in your life, I know recently I saw some people where one person was downsized, the other one had a job change, which was a great promotion, but that shifted some things, and then they have old 401ks hanging out somewhere else. So we encourage you to reach out to us so we can talk about the change in your life and how that affects your financial plan moving forward. All right. Next plan, we always encourage you also to access your financial planning portal. If you're a financial planning client, you've seen this. We can make updates to this and we review this on a constant basis to make sure that you're on track. And as plans and goals change, we always want to make sure that we're helping you make decisions and keeping you on your path to financial freedom. Now, speaking of changes, I want to also update you on one more thing, which is a new team member. So I want to please help me in welcoming to the team, Mr. Craig Sullivan. We're excited to have him on board. He comes with some experience in the industry from another organization, has a 65. He's led Financial Peace, married to Jesse. You can read the slides there, but he's joined Paola and the operations team. So we're very excited because I think he's going to help us anchor us in helping serve you better. Okay, and speaking of serving you better, wanted to also remind you or not remind you, bring to your attention, you may be getting some more emails from us on a weekly basis. We've been trying to, we're in the age of communication, Perplexity, ChatGPT, Google, all that type of stuff. And it's interesting because now I'm competing with, AI as far as financial planning, and we welcome the challenge. We actually had a client who I think is on this call. Say, hey, put my information into one of these AI engines, and I wanted to get your thoughts on it, the recommendation. We went through it, okay, and some were relevant, some were not relevant, and all that kind of good stuff. But in the age of information, we want to make sure we keep you informed, are really present and relevant in your life. So there's more emails, there's blogging, there's social posts that we're putting up on timely information. Like we put some stuff on tax relevant information for this month, but want to make sure that in your email you may see an email coming from us from a different format. It might go to your junk mailbox because we're increasing the volume. We've contracted with a company that's helping us push these emails out. So if you see something from us that's not that hits your junk mail, we'll try to let you know that it's in there, so you can move it over and make it, user friendly and make it a welcome email addition to your inbox. And feel free. Of course, we hope that you read them all. You don't have to, and of course, we hope that you don't block us. But you're welcome to do that as well, because as you know, we're a phone call away or an email away or a text away to be able to answer and help you down your path to financial freedom. So that being said, again, please feel free to ask any other questions you may have. I know a couple of questions came in. So one question that came in, it says, I know the world is a mess, and at the same time, I want to make sure that I'm doing everything I can to help you. What are some of the things that you can do to make your financial plan a little bit easier? I noticed the facts in geopolitics that countries are losing faith in the USA and that some countries are moving away from the dollar. I don't know if I missed you talking about that. Ah, okay. And now there are cryptocurrencies too that might make the trends not the same as above. So, Jason, you want to address that?
Yeah, absolutely. I did touch on the dollar here, and as you can see here, it's been a long-term uptrend, but over the last few years, it has been in a downtrend, and it is testing this long-term uptrend right now. So that is something we're monitoring very closely, the dollar. I will say that over time, that this is not the first time that this has happened. It happened in 2008. I remember the famous model Gisele Bündchen, who said that she was only going to accept payment in euro. And that literally was at the bottom of the dollar. And the dollar started uptrending there from then. So I certainly am aware of that. We are aware of it. And it is something that we're very closely monitoring. And if the dollar does get weaker, as I mentioned, there's some attractive areas to potentially go into, gold being one of them. International emerging markets tend to all do well. Emerging market local currency debt, all of those things we already own, and we even added to on the recent pullback when the market gave us an opportunity to get in at a better price. So we have our portfolios positioned so that if the dollar does continue to weaken, our portfolio should outperform in that scenario. But we also can't just assume that since the media headlines are bad about that, that's going to actually happen. As we saw when the war first started, I'll zoom in. This is when the war first started, right here. This is a chart of the dollar kind of zoomed in. The dollar actually rallied on the start of the war, which means it's still considered a safe haven of the world. When a lot of money flooded into the dollar when the war started. So that would kind of go counter to the kind of perception that countries aren't trusting the U.S., which I don't doubt that point. That you definitely see a lot of that. But what I'm saying is they may say that, but behind the scenes, what are they doing with their money? And what they're doing with the money, the dollar actually went up during that time. Now, like I said, we still do believe that the dollar is getting a very close point to testing a long-term uptrend. And if it does go into a long-term downtrend, we are already positioned for that scenario, and we should do well in that type of environment. On the point he made about cryptocurrencies, cryptocurrencies have actually gone down quite a bit this year, but we certainly see the opportunities in cryptocurrencies over time. And when they rally and go up, they go up really fast. On the other side, when they go down really fast. So I would just kind of leave you hanging with the breaking news point right here that we do have a strategy now that should attempt to kind of take advantage of not only crypto, but also other alternatives in a scenario where maybe the dollar does weaken. So we will be giving a webinar on that this quarter at some point, and be going a little bit deeper into how that strategy works.
Yeah, and that'll be important, especially as to reaffirm your style of money management, which is to try to minimize volatility and protect the downside. So I know we've been staying away from crypto for many years because how volatile. I mean, we saw it drop what 70, 80% of the day.
84%.
84%. Yeah, a few times. So I know things are stabilizing, but I think
And that's
please, if you
Bitcoin, which is
that's
Bitcoin,
right.
the safe one, if you
That's
will.
right. That's right.
Otherwise,
So we are obviously taking into to account that strategy and the dollar. So please stay tuned. And if this is of interest to you, please join us or please watch the video that Jason's going to put out about our new strategy as well. And just so you know, you said he, Jason, that was Patty. So thank you, Patty,
oh, sorry.
for that question. I know you didn't know who was asking. We do have another question here. It says, out of curiosity, you guys put people mostly into index funds, right? Question mark. No, well, I'll let you answer the question. If so, have you heard anything about if you guys are doing anything about the fast track rule changes and the float changes for NASDAQ and potentially other exchanges? I ask specifically because of the likely SpaceX IPO coming up. Index fund holders are probably going to get screwed, QQQ, etc. Not expecting a quick response, just was curious. Well, how about giving them a quick response?
Okay. Well, there's actually 3 points there. I know we only have a minute left, unfortunately, but
I know.
So those rules basically could potentially allow an IPO like SpaceX to get into like the Nasdaq 100. We currently hold QQQ in the portfolio. That would be the Nasdaq 100. And what he's concerned about, which I'm with him on this, is that SpaceX is currently valued at $1.4 trillion. Last I checked, which would put it as the ninth largest company in the world. It puts it 40% higher than Berkshire Hathaway, which has been around 50 plus years. And it is in it with not the revenue or the earnings, not even close, like a fraction of the earnings in revenue of other companies that are valued at that size. So by it going into that index, then that could potentially cause that index to own a stock that is very highly valued, which could potentially go down. So that is something that we're monitoring. We are aware of it. At the same time, let's just say, for example, we hold 10% in QQQ, and it ends up being one of the holdings in QQQ. And let's say it ends up being like let's say 3% of that QQQ holding. Well, that would mean the entire portfolio is only exposed to 0.3%. So all that to say is we'd be very diversified. If that was to happen, it wouldn't have a huge effect into the portfolio. At the same time, one of the other questions is, no, we don't actually only invest in index ETFs. We have a core portfolio that does invest in some index ETFs, but then we have an explore portfolio that uses more factor-based approach, which can exclude overly expensive stocks and focus on stocks that are at much better valuations. So we are aware of it. It's a good point. The last thing I would just point out there is we've had some interest in SpaceX. I would just warn investors, not that it's not a good company and it's not going to do well over the long run. It is is extremely hyped up right now, and it's so much so that the valuation, like I said, extremely high. What we've seen over time is those overly hyped IPOs like a SpaceX will, after they IPO, they may get an initial jolt, but then after you give it a couple of weeks, they do come back down to earth, pun intended on that one. So usually within that first year, a company like a SpaceX that was overhyped does come down to much more attractive levels. And don't think you need to necessarily buy it on its own stock. A lot of our funds that we use are looking for better deals, and when it does come down, a lot of times it will actually add it to the portfolio automatically. But I would just give people a warning there. Be careful with SpaceX. Even though it's a great company and it'll probably do well in the long run, it's super expensive right now, astronomically expensive.
Very good. Well, Jason, thank you. I know we're a couple minutes over. I want to thank you for attending. Again, you should get a copy of this recording in the next 24 to 48 hours. And of course, if you didn't get a chance to ask us questions, please feel free to do so. Reach out to us. We'd love to chat with you, and wishing you a great second quarter. Thanks so much. Take care.
Thank you, guys.